Hello, Take on the Week listeners. I'm Telis Demos. I write for the Wall Street Journal's Heard on the Street column, and you're listening to a very special, very bonus episode of WSJ's Take on the Week. As you all know, we've been seeing some wild stuff happening in the market lately. We've had huge days of up, huge days of down in the stock market. We've seen trading in the bond markets that really has puzzled people and sparked all kinds of debates about what is driving them and what's going on. And amidst all of that, how on earth are everyday investors supposed to figure out what's going on? So, I am joined by my colleagues, Miriam Gottfried and Spencer Jakab, and we'll be answering a bunch of the many questions that our Wall Street Journal subscribers have had over the weeks in regards to the things happening with tariffs and what it means for the stock and bond markets. I can't promise that we'll have all of the answers, but we'll do our very best to help guide you to be a little bit of a port in a storm for everyone. Miriam, Spencer, thanks for joining.
Good to be here.
Thanks for having us.
All right, let's get started with our first questions from the audience. Number one, very topical, pocketbooks kind of question. What consumer segments do you think will be most impacted by these tariffs?
Normally, in these cases, if you're staring down a recession, if you've had a big sell-off in the stock market, the main culprits normally would be consumer discretionary segments as opposed to consumer staples, kind of wants versus needs. But it's a little bit more complicated this time because you have certain things that are very specifically impacted. You've had big declines in the shares of people who do auto repair and who sell auto parts because autos are specifically being targeted, and a lot of those happen to be imported, and they're subject to the same kinds of tariffs that cars are. But then there are other things that are doing relatively okay, relatively speaking, ports in the storm. But it's much more complicated than it usually would be.
But I still think that some of the usual suspects are getting hit pretty hard, like consumer discretionary apparel companies. We saw what happened with restoration hardware. A lot of those guys get the bulk of their goods from overseas. So they will be very exposed to whatever tariffs end up being the final tariffs. And a lot of those items are not staples. They're things that people can decide to hold off on.
Spencer, I want to second what you said about autos. I think that auto loans are something we should be looking at closely for a couple of reasons. One is that the tariffs on autos and auto prices, they're coming, right? They're not part of this 90-day pause thing. So I think we can look with a little more certainty at that. And that drives up a couple of things. One is the price of insurance, potentially, right? Like auto insurers, if it costs more to repair cars, they're going to raise your rates, right? So everybody pays more to own and maintain their car. And number two, people who might be buying a car, I think, are going to be looking at having to pay more for that car. And already people have stretched the terms of their auto loans, right? Like people are already doing 7, even 8-year auto loans. You can't get much more than that. So I think autos are a real watch zone for me. Let's move on to question 2. Why were stocks having a huge day Wednesday despite the China tariffs increasing to 125%? And I'll say subsequently they went up to 145. Even with other tariffs on hold, isn't that the most important thing?
From all the people I was talking to, they were just really relieved to know that negotiations were possible, that what we heard on Liberation Day was not set in stone and that there was room for movement. And I think there's probably some hope that even the across-the-board 10% tariff could one day not be there or be open to negotiation, or that maybe some of this stuff isn't quite as firmly established as previously broadcast.
I agree with that. The markets were like a coiled spring. You saw the day before there was a false headline that there would be a 90-day delay, and you had this massive rally in the middle of the day. And so you knew that when any concession was coming, that it was going to be to unleash this kind of violent wave of buying in stocks, and it did. We had one of the best gains in the S&P 500 since the financial crisis, the best gain in the NASDAQ since the recovery from the tech bust. And intraday, I think it set all kinds of records because you finally got the sense that the White House was seeing the damage that it was doing, not because the tariffs still in place are so good, because just the tariffs on China alone, weighted by what we buy, the typical basket of goods that Americans buy, is really substantial.
All right, we've got more questions for Spencer and Miriam after the break. All right, guys, welcome back. Let's keep going. Is there any way to know what's going on with the market besides guessing if the president got enough bad news to change his mind. So are there things I should be looking for to know that now's the time to buy? Couldn't it all change if suddenly the president, just singularly, right? Sometimes we talk about the president, and what we really mean is like the large apparatus of the executive branch and agencies and things. But in this case, it literally means the president, a singular person, could change his mind. I don't know if there's anything that you should look, right? Like, we got a really good job market report last week, right? We got an inflation report that suggests that, at least for now, like, prices are not running hotter than people were anticipating. That's good economic data. But at the same time, you're getting consumer confidence and business confidence indicators that suggest that people are very nervous and worried. So if you're looking for like, okay, here's the economic truth of the matter, trade on that. I think that, as you've written about, Spencer, we could be easily talking ourselves into recession.
I think what really shocked people in the last 2 months, this is a president who tweeted. You never used to have presidents make statements on their personal social media accounts about the stock market, usually self-congratulatory stuff, or cajoling the Federal Reserve to cut rates to help the stock market. Of course, we had a pretty severe bear market because of COVID during Trump's first term. He seemed unconcerned, and that's what shocked people. And the market finally found his pain point, which is that the bond market began to break down. So this is not something that we're seeing in backward-looking data like earnings during the first quarter or jobs last month, but it can have very severe repercussions. And I guess that finally got through to him. So the market did find his pain point, and that continues to get worse, even though he put a 90-day pause on some of the quote-unquote reciprocal tariffs on all countries but China. That continues to deteriorate. So stay tuned, because the thing that made Trump blink is not fixed. And I think that even backing down on everything that he's done, including the standoff with China, is not going to fix it, because you can't put this genie back in the bottle. That's the real problem here.
That was the thing. It was the 10-year and yields and the cost of the government debt servicing and mortgages. These are things that Trump really cares about, or he's talked about caring about. He talks about how he wants interest rates to go down. And those numbers were what was, a lot of people think, finally convinced him to institute the pause. But as Spencer said, the pause hasn't been enough to assuage the market.
All right, well, we've got one more question for you guys after the break. All right, welcome back. Final question. Does the U.S.'s, and it's a big one, okay? Does the U.S.'s reputation for stability and reliability ever recover from this mayhem? The decline in the dollar and dumping of treasuries suggests not. All right, guys, what do you think?
I don't think it's going to recover anytime soon. I don't really know how long these evolutions take. We've had different eras of tariffs and trade policy throughout the course of our country's history, but I think it will take a very long time for us to recover from this incident.
Yeah, I agree. There's a big mismatch. Think about in your career or in your life, how many years or decades it takes to establish a relationship and how one or two dumb things can completely tank it. We've done those things, and it's difficult to regain, because even if Trump wises up about the panic that he's caused in the global economy, he could change his mind. And even when there's a different president in power, Congress went right along with all these things. Let's say his own party at least didn't protest very much. And that shows a weakness in U.S. institutions and will to lead. And that's going to be difficult to fix.
Look, obviously, we've seen a wild bunch of sessions and scary things happen. The U.S. treasuries and the dollar not acting like safe havens. There's a lot of gamesmanship going on now. I don't think we know yet what other governments are doing to attempt to force Trump's hand in the way that they manage their portfolios of things and the way that they sort of run their own kind of currency policies. I don't know if we can just draw a straight line from what we've seen these past weeks to what things are going to look like in the future. And as we've all been talking about for many years, the fact that because the U.S. ran these big deficits, it put a lot of treasury debt in the hands of central banks and other countries, which means that we're all kind of in this together to some extent, right? The U.S.'s future fiscal situation matters to other countries. They can't just like write us off and say, haha, good luck to you guys. We'll see you later. I don't want to quite say that we know what the future of the dollar or the U.S. Treasury is until we get a little further through whatever negotiations are going to come out of this for the next few days. I also think that we've been talking tariff. In the background has been like a really intense debate about the U.S. budget. Like the Republican Party controls both chambers. They have the presidency, and they have some big ideas about the U.S. budget and the fiscal future. And so I think what happens in that process, and where does the Republican Party come down on this question of, okay, well, tariffs are going to generate these revenues, and so we're going to use those to offset tax cuts. And what's the ultimate number for what the Department of Government Efficiency is doing? That number is always changing. How much did they actually cut out of the budget? So I think that before I want to fully answer that question, I think that we need to see what's happening through that process. And I think there's more that people are paying attention to there than we are talking about, just because there's been so much going on in tariffs in the stock market. People who, are really diving deep into the future kind of reliability and fiscal picture of the U.S. are probably paying as much attention to that as they are to what's being said on Truth Social.
I agree that those things are very important and that holders of U.S. debt are definitely focused on that kind of stuff. But I want to go back to what Spencer was saying before, which is that fundamentally we've shown that we can make, as a country, decisions that appear like unilateral and coming from one person without many checks and balances, and that could be reversed with the stroke of a tweet. And I think it just makes the U.S. seem like a much more risky place to invest.
Is there a better alternative? Is there enough gold, or is the euro strong enough, or something else that really represents an alternative kind of global currency to the dollar yet?
Yeah, you're right. There is not enough gold in the world. I guess there is enough gold in the world because every micron of gold can be worth some huge amount of money. But we're not going back to the gold standard in a world where there's an international reserve currency. But just because we can't imagine a world where there isn't one, that's the basis for everything, doesn't mean that there won't be one. And even if the dollar retains that status, it can have a diminished version of that status. These Doge cuts haven't saved any money, first of all, yet. But even if they do save a lot of money, and it's not nowhere near the imagined amounts, because that's impossible. And it's not even going to come close to approximating the annual interest bill. So it is a problem. And this rise in yields, by the way, has a kind of a feedback effect eventually, because higher yields make the fiscal position of the United States more acute, since interest is a not insubstantial part of what we pay. And the higher the rate, the deeper hole we're digging ourselves in. Doesn't mean that you go from one day to the next, the U.S. being and then not being the global reserve currency, but it's got problems.
You do make a good point. This isn't tied to U.S. debt necessarily, but U.S. markets writ large. I was talking to some people at Goldman Sachs at their recent asset management day, where they brought in members of the media to talk about aspects of their business. And they were saying large sovereign wealth funds might be thinking, oh, now's a time to rotate out of the U.S. But if you're really a very big investor, there isn't necessarily a place to go that could absorb all of your money.
Tina, there is no alternative.
Yeah.
Tina America. All right. Well, we did our best, folks, to answer your questions. They were great questions. Hopefully, we gave everybody some food for thought. Keep following us here at the Wall Street Journal. That includes Take on the Week, obviously, your number one destination for this sort of analysis. But in general, read Spencer's morning newsletter, read Miriam's coverage of the wide world of private investments, and just keep up with what the Wall Street Journal's got going on. Because as we get the answers, we will share them as fast as we can. To hear even more, though, about the markets in particular, be sure to listen to our episode coming out this Sunday, where we will be joined by PIMCO portfolio manager Chris Kraus for an in-depth conversation on how all these economic changes are impacting the consumer.